Hi, I'm Erik Renander from the Hedge Invest Africa Opportunities Fund. I want to give you an update on August. It was a difficult month. The fund was down over 3%. A lot of the problems that have been hitting emerging markets all year finally rolled around and hit Africa. The South African index was down 8%, and the Dow Jones Titans Africa Index was down over 7%. Our short portfolio helped us this month, but it wasn't enough to offset the losses in the equities and the bond portfolio. It doesn't seem like a coincidence that we're having problems in Indonesia, India, Brazil, Argentina, Russia, China, South Africa all at once. While the Fed interest rate increases have been well known and well telegraphed, I think the combination of interest rate increases with a decline in the Fed's balance sheet of $30 billion a month has had a bigger effect than we all expected. I think also we have to realize that this is a trend. This trend of dollar strength and stress on emerging markets may be something that continues a little bit longer than we expect. So during the month, we've reviewed our portfolio, our positioning, and our outlook, and we've been taking a more cautious stance on things, and we decided to reduce our positions and exit our bond portfolio in Ghana, Zambia, and Nigeria. We've done well on the bonds, but we want to be careful about these currencies, which they're relatively illiquid currencies. We just wanted to play it a little bit more safe and get to keep the fund invested in more liquid currencies. We also reduced our Nigerian banks position. The valuations of Nigerian banks are quite attractive, but again, we want to be very careful about our exposure to currencies like the Nigerian naira. We've also reduced our positions in the mining and energy sector. We've seen a sell-off in some commodity prices, such as platinum, gold, and copper, and nickel. Also, given the stresses in China, we just want to be very careful about that sector because the outlook's a bit more questionable now. And then finally, on the short side, we've increased our short positions in South Africa, especially on stocks focused around the small businesses and the consumer. There's a lot of stress in South Africa. The economy's been behaving poorly. The weakness in the currency means prices are going up. There have also been increases in VAT tax, fuel surcharges, electricity costs, and there's a lot of pressure on the disposable income in South Africa. And you're seeing that come through in the earnings. So we have some short positions in South Africa, and also especially in the banks, where the banks in South Africa have had historically low loan loss provisions in the last 2 years. And we think given the stresses right now, that's unsustainable. And we just think they can go back up to more middle of the range losses, and that would have a big effect on the prices of South African banks. There's also an accounting change, IFRS 9, which means banks have to be a bit more proactive about credit provisioning. When they see problems coming, they have to take provisions proactively, which is something they didn't do in the past. So I think these two things together are going to see quite a big tick up in South African bank provisioning going forward. And I think that's going to be more than what's expected by the market. So the sell-off in emerging markets and these stresses are not what we expected at the beginning of the year, but we're going to have to, I think they could be a bit more persistent than anyone thought. And we're going to have to, we've adapted the portfolio for the new environment, trying to find new winners and losers. On the winning side, we're trying to find stocks in South Africa that are exporters that can benefit from the rand weakness, or they have an offshore subsidiary that's doing well. So we're trying to find the new winners and losers to keep making money for the investors. So thanks very much.